Welcome back to Wall Street Silver. Lyn Alden, expert market strategist, analyst, economist. Thank you for joining us today.
Happy to be back. Thank you for having me.
Yeah, Lyn, you were one of our early guests when our channel was new a couple of months ago, when we only had a few thousand subscribers. We're up to 25,000 now, and part of it is getting great people like you to join us and provide great content for our audience. So we really appreciate it. Lee, you want to kick it off with the first question?
Sure. We had quite a sell-off today in the market. It started, I think, last Friday. Do you think this is going to continue? What do you think is driving it? Is the repo market playing into this? What are your thoughts?
Well, I think a lot of this current sell-off is a combination of, fiscal stimulus has partially weared off at this point, right? So a lot of people got checks and things like that, and that's kind of, as we go months away from that starts to diminish. But then two, we're starting to see, for example, the Delta variant, right? So there's news about that, and it's it's not just a medical question; it's also the government responses to that, right? So there's kind of the medical question, but then there's also the economic question of what localities are going to lock down. How's consumer behavior going to change if we start to see that happen? And so I think we're kind of, the market is sort of freaking out a little bit about that and saying, okay, well, some of the fiscal stimulus is not as impactful as it used to be, and we're seeing some headwind to the economy. And so that reflationary trade that did very well for a period of time is kind of cooled off. So we see bond yields down, we see commodities down, we see cryptos down. We see some of the more cyclical stocks down, right? So even though the S&P 500 has been really strong, if you look at breadth under the surface, things that are more tied to the economy, like banks or industrials, they've been weaker, whereas some of the mega cap tech stocks that are kind of economically agnostic, they've still been doing very well until today, when kind of most things are down. And so really, I think it's kind of a deflationary impulse. It also, it clears excess out of the market. So we've been taking away these kind of meme stock valuations and kind of clearing out a lot of that kind of excess, so that when this eventually bottoms, market participants can separate the wheat from the chaff for the next round of activity.
When you say yields are coming down, just as a flight to quality, as institutions rotate out of stocks and move to treasury securities?
Yeah, we've seen that happening. So 10-year yields have fallen pretty quickly. And it's interesting because that's despite the fact we've had inflation surprises to the upside. And so we've had kind of the treasury market say, we think this is going to be transitory. So the bond market seems to be agreeing with the Fed. Now it's complicated because the Fed is still buying a lot of the treasury issuance, right? So they certainly have their thumb on the scale in terms of impacting the supply and demand of that market. But even in that context, you do see varying private demand. Part of the treasury purchases, it's not so much kind of, there are traders buying it, but if you look at actually who's accumulating large amounts of treasuries, part of it is the pensions. So they're actually pretty big treasury buyers. Some of the banks, like Bank of America, have been buying treasuries, and then a little bit around the foreign sector, right? So we've had kind of foreign sectors not been buying treasuries as much as they used to, for years now, but there are periods of time where they kind of come back to the market, specifically when their FX hedged yields become better. And so, for example, if you're a Japanese or a German investor, there are periods of time where you can buy a U.S. treasury, hedge it back into your own currency, so you eliminate the currency risk and still get a higher yield than buying your own government debt. And so some of them will buy the treasuries in that way. And so right now, those are kind of the three big sources of demand besides the Fed.
But gold is barely down at all today. I'm going to share a gold chart just for today is Monday, just for our audience when we're recording this, and I hope to have this out Tuesday. And the gold chart, is just down $2 or $3 right now, barely down at all. Whereas the silver chart is way down, 2.5% type of move. What do you see this? We're a precious metals channel. Speak to what's going on in the precious metals market in relation to the chaos in the market overall right now. How do you see that?
Yeah, so what we're seeing right now is kind of characterized as a disinflationary move. So people are pulling out of risk assets into defensive assets. People are concerned about, say, how the new virus variant or lockdowns could affect consumer demand. could cool off inflation a little bit. For example, you could have less oil demand as an example. And so generally in disinflationary environments, gold outperforms silver. And so, for example, if you look from the period from 2018 to 2020, you generally had gold, doing a lot better than silver. And then ever since that March bottom of 2020, we've been in this more reflationary environment. You generally had silver outperforming gold. And so when you get these kind of deflationary or disinflationary pulses, it's not too surprising to see the more volatile metal silver go down more than gold. Whereas if you were to get a big inflationary impulse, I would expect to see silver outperform gold. So it really kind of comes down to that, is it more of a disinflationary environment, or is it a more pro-inflationary or stagflationary environment?
Do you see this as maybe the early stages of another, I don't know, March 2020, where they, the market tanks, lockdowns, more stimmy checks, Fed balance sheet explosion is like the next step of this, perhaps? Do you see that coming, or am I getting a little bit too apocalyptic here?
I don't think the magnitude would be as large as March 2020. I think part of it is a medical question that I'm not very, likely to answer. But one thing I would observe is that I think, the more this repeats, the less kind of tolerance, the public has for this cycle, because, you can't, every time you lock people down, you have one of two choices. You either compensate them with printed money, or they just lose value, right? So if you tell a small business that they can't operate, you don't compensate them, then they, if they eventually go out of business, then basically Amazon takes that business, right? So we just kind of consolidate value up the value chain into the big mega caps. And so that's obviously not something that most people besides the corporations would want to happen. And so, it's pretty clear at this point that, the virus in various forms are going to be with us for a long time. We don't lock down the economy for the flu every season. And it's, obviously this virus is still somewhat more potent than the flu. So it's not exactly an apples to apples comparison, but when you compare it to other causes of death, so basically I've described it as we have to watch three variables. We have to watch the medical variable, the virus, what variants are doing, how contagious are they, how deadly are they. Then we have to watch political responses to that. So are politicians doing lockdowns or not? And then we have to watch the public responses to those political responses to see, is the public accepting it? Are they on board, with that? Are they pro, locking down and trying to eliminate deaths as much as possible? Or are they kind of saying, we're sick of lockdowns, we're going to go protest against it, we want to, vote those people out of office? So, and obviously you're going to have different answers in different countries or different states. Basically, I think it's a similar situation to March 2020, but we've had a couple of these waves before too, right? And so this is the one that's a little trickier because it's starting to impact even vaccinated people in some cases, and so it's a little bit different than those waves. But I think overall, it's the probability of complete lockdowns like the whole world experienced in spring of 2020, I think, is less likely the more this repeats.
I think you're right, because it hasn't been in the mainstream news, but if anyone who's active on Twitter, I'm sure has seen all the tens of thousands or hundreds of thousands of people protesting in Greece, France, various European countries. And frankly, if the US government tried to suggest another lockdown, I think there's a lot of states like Texas, Florida, who would just completely ignore them this time and would just say, no, we're not going to do it. But Lee?
When I see a broad market sell-off like this, pretty much almost every asset class is down. You have Bitcoin down, you have the broad indices down in the US, you have gold is doing better, but it's still down. You have silver down. To me, that spells like there's some sort of liquidity crisis brewing. Would you agree to that? Especially we saw Wells Fargo cut back their loan program, and then we also had the whole repo issue. What are your thoughts on global liquidity?
Yeah, so I wouldn't describe liquidity as a crisis, because there are signs of, you can watch like acute liquidity issues. So it's not any sort of thing like that we started to see in, say, late February or early March of 2020. So it's not to that level. But I do think that in terms of watching liquidity, it has topped and rolled over. So basically that we kind of hit maximum liquidity. In fact, there was so much liquidity that banks had to store that liquidity somewhere, and they kind of stored it in the reverse repo market. And so we kind of hit max liquidity, and then now we're kind of coming off of that high. And so some of the trades that were based on liquidity are cooling off to some extent. And then you can also combine that with solvency, where, say the Fed can't do anything about solvency, right? So if their business is failing, they can make rates cheaper, but they can't give money to people, whereas the fiscal authorities can, right? And so that's what they did, over the past year and a half. But if that's not repeating, then if there's lockdowns and there's no stimulus, for example, then more businesses are prone to fail because they have their cash flows interrupted and they're not being compensated. And so we'll see how that plays out. So I do think that basically, solvency and liquidity are both kind of cooling off here, which is a challenge for risk assets.
Do you think that's going to continue? Do you think it's going to develop, just if you will, or do you think we're kind of like going to bottom here and maybe find a level?
So we are starting to see that sentiment's getting pretty negative. So I wouldn't be surprised to start seeing a bid. I think it's too early for me to say with any sort of conviction where this is headed, because again, you have to look at the medical aspect, which I'm not an expert on, but then also you have to kind of monitor the responses, the political and the public responses to it. So I'm kind of watching it. But if we do get capitulations in some of these assets, I would certainly be happy to rebalance into those without trying to call a bottom or trying to call what's going to happen over, say, a 3-month period. But kind of, keeping my eye on the multi-year long term. And so if I can get a really good deal on silver, if I can get a really good deal on Bitcoin, if I get a really good deal on oil producers or oil transporters, right? If these things have capitulation bottoms, I'd be happy to rebalance into those types of assets and kind of pick up dollars on the street if people are willing to leave them there.
I'm going to share the 10-year chart right now. And you can see this is going back to the virus of last year here, and in this channel, and we've sort of broke out up to 1.7 or so on the 10-year Treasury. But it just seems, is this just a pure flight to quality or fear? Need somewhere to park money? Because you'd naturally think with 5% inflation that buying a 10-year bond at 1.2 doesn't make a heck of a lot of sense in terms of real yield. Why, how do you sort of interpret this in this inflationary environment with the 10-year yield just tanking?
Yeah, so it's a huge decoupling between inflation and yields, as you pointed out. And it's actually, you'd have to pretty much go back to the 1940s to find a similar environment where you had that big of a decoupling. And so that's an environment that I've been kind of comparing this period to ever since last year. And so, overall, I think there's a couple factors there. One is the bond market partially believes inflation is transitory. Another factor is the fact that the Treasury General Account has drawn down considerably. And so they've pushed a lot of dollars back into the market. And so what that means overall is that basically when the Treasury General Account's going up, so that's like the Treasury's account with the Fed, that's like their cash bucket. And when that's going up, it means that they're issuing more bonds than they're spending of money. And when they're drawing that down, it means they're spending more than they're issuing bonds for. And so because they hit record high levels several months ago, around like 1.8 trillion, they've been drawing that down closer to normal levels. And so what that means is they haven't been issuing as many treasuries as they would otherwise have to issue for this type of fiscal spending. And so you kind of have like a treasury shortage in a way, at the same time as the Federal Reserve is still buying tens of billions of dollars worth of treasuries per month. And so there is kind of a collateral shortage in many ways. And so you have your banks are stuffed full of liquidity. All these financial institutions have dollar liquidity, and they can either earn zero on it or they can go out and buy some treasuries. And so we still have a positive yield curve, right? So, if you're choosing between T-bills and T-bonds, you have different risk profiles. If you hold T-bills, you're earning less yield, but you don't have interest rate risk. You can go out and buy a 10-year treasury, you get more yield than a T-bill. But of course, you have interest rate risk, if those yields go up. And so, the market's kind of stuck between a rock and a hard place where the Fed's holding rates at zero, and then everything's kind of priced off of that.
So, the big question is, the night we've got this inflation spiking, over 5% year over year now. The Fed, we don't have a Paul Volcker personality in the Fed right now. A lot of people argue we don't even have the flexibility to raise rates like we did in the 70s because of the sheer debt to GDP burden that we're under. If the inflation does continue and it's not transitory, as we as precious metals investors We don't believe it's transitory. We think it's getting worse. What's in the toolkit to bring inflation back under control going forward?
Not that much, and that's why I do compare this period more to the 40s and the 70s, because in the 70s you had low debt levels as a percentage of GDP, and so that when there's inflation, they could raise rates to try to contain that. Whereas people that are familiar with the 40s, you had very high inflation. The whole decade was about as inflationary as the 70s, but actually the peak inflation level was even higher. So 1942, for example, you had 19% inflation while interest rates were zero. They just held rates at zero for pretty much the entire decade, no matter what inflation was doing. And there's kind of two reasons for that. One is that debt was so high, specifically government debt was so high, that they had to hold rates low in order to allow the government to basically fund itself, right? So you just kind of inflate the debt away, in a matter of speaking. And then the second reason is that the whole point of raising interest rates is to kind of try to calm down lending, to basically have less lending happen, because bank lending is a key source of money creation. And when you can put the brake on bank lending with higher rates, and so with the 70s was that increase in the money supply, that inflation, was in large part driven by a lot of bank lending that was happening, combined, of course, with oil embargoes and other shortages in real goods. Whereas the 40s, you didn't really have much bank lending. Most of that increase in the money supply was from fiscal spending related to the war, and the GI Bill when people came back from the war and things like that. And so this 2020 and 2021 period is more like the 40s, in the sense that this inflation is not coming from bank lending. It's not like banks are lending and therefore interest rates won't make them lend less. They're already not lending that much. And instead it's coming from the fiscal authority. And so, I think the Fed is hesitant to raise rates here. And, another difference between bank lending inflation and fiscal inflation is that bank lending inflation tends to be more persistent. So in the 70s, you had a more persistent type of inflation, whereas the 40s, it was almost, combined, especially combined with wage and price controls. But really, the fiscal type of stimulus is more of an on-off switch, because it's partially the top-down type of money supply increases. And so we're kind of in that environment now where you can have a pretty inflationary environment while fiscal stimulus is happening. And then if they cool off fiscal stimulus for, say, 3 years, you could go back to a more disinflationary environment until they're forced to do another round of fiscal stimulus. So you could have these kind of off-on periods for inflation, and the Fed's likely to hold rates at pretty much zero through that. So you have periods of currency devaluation or debt devaluation.
Well, when you talk about you're comparing us to the 1940s and that situation. I mean, if I recall, gold was fixed at that point. It didn't trade freely, so we don't have a good historical comparison for how it would have reacted in this economic. Is there any proxy that would tell you how gold should behave in this type of environment then, if you view this as the 40s?
Yeah, it should over time do pretty well, but the market would have to kind of realize that inflation is more persistent, for it to do well. And so, in the 40s, gold was pegged, but for example, you could see the performance of oil, silver, and copper. They did well. Housing did pretty well. Stocks did pretty well, but they of course started from a lower valuation standpoint. And so generally hard assets did well in that inflationary environment. Gold, historically, ever since it was unpegged, follows real rates pretty closely. But the tricky thing is that, especially in the modern market, they don't follow current rates. They follow inflation break-evens, right? So they follow the Treasuries market's kind of longer-term rate forecast. And so gold is following break-evens pretty closely, rather than following, say, the current year-over-year inflation level. And so overall, I would expect it to do pretty well, if this environment keeps up for a long period of time. Another way to look at it is that, we don't have the day-to-day price fluctuations of gold during that time because it was pegged, but we can still look at the starting point and the end point, because once it was unpegged, it kind of quickly, moved up to a clearing rate. And so if you compare, say, gold in the 30s to gold in the 70s, and you can kind of say, okay, what was the annualized rate of return, right? So gold went up something, depending on exactly which points you measure from, gold went up something like 7x, say from the early 30s to the mid 70s. That's not even to the top. That's not even to like the 1980 period, but just to like the mid 70s. That was like a 7x increase, from $20 to over $150. And so I think that this environment is pretty good for real assets in general, but you have periods of time where say the bond market is not sure what inflation is going to be like, how persistent it's going to be. And they're seeing things like lumber come off their highs. So they're saying, oh, look, it's transitory. Whereas I think what the market should be watching right now is rent prices, because we're starting to see rent inflation bottom, the rent moratoriums, ending. We generally see rent prices and owner's equivalent rent follow housing prices with maybe like an 18-month lag. And so most signs point to rent inflation as we move into the second half of this year. And that could keep, say, the broad CPI measure more elevated than some of the, say, transitory inflationists think it is, right? So the people that are kind of
Yeah.
looking towards disinflation might be somewhat surprised by how CPI kind of levitates. Now that could be thrown off by, say, an extreme Delta variant that crashes the oil price and another round of lockdown. Or a renewal of rent moratoriums. So there's all these kind of political curveballs that could come in and impact that temporarily. But I think the longer term trend is towards kind of a stickier type of inflation.
So do you think the outlook for precious metals should change kind of on a dime as things clarify?
Yeah, I mean, you could have, just like how today you're having a bloodbath. If we start to get good news on that front, right, you could have a day of just green across the board for the metals. And so, I think it's one of those things where it pays to be somewhat diversified so that you can rebalance into periods like this. And if you see extreme sentiment, you can potentially take some off the table. It depends on how long term your time preference is. And so, I think it's going to be something to navigate. It's not going to go up and down in a straight line, but I still, in general, like real assets. And in addition, I think some of the miners are pretty attractive because, compared to the metals that they're mining, many of them are still pretty cheap and they're generating a lot of free cash flow from the current price level.
I know a lot of our members have gotten frustrated with the price of miners and the stock price just going nowhere. But I think it's really important for people to keep in mind the time frame they're investing in. These things can go up and down, but longer term, are you thinking like 5-10 years from now? Are you thinking the next 6 months? What's your time frame with investing in such a thing?
I usually invest with a 3 to 5 year time horizon. I often think out 10 years, right? But if something's not working by 5 years, right, you probably timed it wrong. So I generally go with a 3 to 5 year time horizon for most of my investments. But then I do watch, part of my, kind of macroeconomic analysis is not that I'm going to make changes day to day based on what's happening, but it's partially to set expectations, right? So I'll say, okay, we're seeing this roll over. It looks like we're in a more disinflation environment. We'll see what kind of deals come our way. We'll see what sells off, what gets cheap. And so, I generally have that 3 to 5 year time horizon for actually picking and holding investing. But then, following this nearer term stuff to kind of, rebalancing opportunities or trimming opportunities, or just making sure people understand the context within that longer term time frame.
Makes sense.
I want to sort of change the subject. I just saw an interview you did where you were talking about how, who's that guy from Mike Maloney's show? Adam Taggart?
Oh, yes.
Yeah, you did an interview with him and you were talking about trade and the US military and how the US military basically pays for global security so that oil and trade can move around. And that we're no longer seeing the USA, while we're paying for the cost of this whole system, we're no longer accruing the benefits of this system. And I was wondering if you could go into that for our audience, because I found that little segment you did with Adam really interesting. If you recall it, I'm not sure how old the interview was.
Yeah, that was a couple months ago, but that's a subject that I've been focusing on pretty heavily since last year, and I have a long form article on it as well. And basically, it's kind of Triffin's dilemma, right? So the current structure of the dollar, the global reserve dollar, basically, in order for the U.S. to maintain the system, we have to run these structural trade deficits. And the way that works is that basically the United States made deals with OPEC back in the 70s to say, okay, we want all you guys to only sell your oil in dollars. So if France buys oil from you, if Japan buys oil from you, whoever buys oil from you, only sell it to them in dollars. And what that does, in exchange, we give them protection. We have arms deals with them. We defend their shipping lanes. And so that's kind of this mutual agreement. And what the United States gets out of that is that, they're the reserve currency. We're able to basically print dollars for oil. And what those oil producers do is they take a lot of those dollars they get from selling oil and they reinvest those into treasuries. And that makes it so that the whole world pretty much needs dollars. So France needs dollars, Japan needs dollars, everybody needs dollars if they want oil. And so that's the environment we've been in for almost 50 years. And that gives the U.S. a lot of obviously advantages. But then, it also, our disadvantage is that because the whole world needs dollars, there's lots of demand for dollars, which sounds good, but then it props up the value of the dollar, and therefore it makes our exports less competitive. So we become more in the dollar export business rather than making things and exporting them. So obviously that's been hard for a lot of manufacturing jobs in the U.S. The United States has deindustrialized at a faster rate than many of our developed peers like Europe or Japan, because they're actually running balanced trade situations or even trade surpluses, whereas the United States has this gigantic structural trade deficit based around this petrodollar system. And so, the whole agreement there is we get to be like the kind of the world police. We have more military reach than anyone else because our dollar kind of is accepted everywhere. And we have this situation, but we're also defending the global shipping lanes. And all these partners that we run trade deficits with, they take those dollars and they go back and buy treasuries. So in the 70s, and we had giant trade deficits with Europe. They reinvest into treasuries. In the 80s, we had giant trade deficits with Japan. They reinvest in treasuries. In the 2000s, we had giant trade deficits with China. They reinvest in treasuries. But what we're seeing in the past, say, 7 or 8 years, is that China says, okay, it's no longer in our best interest to keep buying treasuries. So we're going to keep running trade surpluses with the United States, but then we're going to take those dollars, and instead of buying treasuries, we're going to go buy hard assets. We're going to go do the Belt and Road Initiative. We're going to make loans to different frontier markets. And if they default on those loans, then we get the ports, we get the infrastructure that they own, right? So China's, basically taking those dollars and buying hard assets. So, over the past, say, 5 years, this whole system's kind of working against the U.S. because it's propping up our trade deficits. We're running record trade deficits. And then also we're still paying for all of this, this safe supply of oil going around the world. And, at this point, China is the biggest commodity importer. We're the second biggest. So we're kind of helping to keep the shipping lanes open for China while they use the system against us. And so it's kind of the system where, the benefits of the global reserve status are pretty linear, right? So we have this kind of long-term benefit from it, but then the costs have become kind of exponential. And so in the beginning, the benefits probably outweighed the cost. And then over time, the costs have now outweighed the benefits, the way that this structure works. And so it's kind of this nuanced subject where, it's actually having the whole system as it's currently structured is benefiting basically the percentage of Americans benefiting from it is shrinking. So if you work in, say, healthcare, technology, government, or something like that, especially if you're in the top 10% of the population, you get a lot of benefits of having the global reserve currency, and you didn't really have any of the drawbacks. You didn't lose your job, you didn't have your wages pressured by globalization. You pretty much got the benefits. Whereas if you worked in blue collar work or manufacturing in most ways, you got some of the benefits, right? So you got to buy some cheap Chinese goods and things like that. But you also paid most of the cost. So your wages didn't keep up. You might have lost your job. So for example, you've seen places like San Francisco and New York do very well under the system, whereas you've had the Rust Belt, become the Rust Belt.
You mentioned New York. You have to look at the state as a whole, because while New York City metro area has done very well, you go upstate, it's desolate. You've had major companies pull out of there. So
yeah, it's very similar to the Rust Belt in that sense. A lot of that same thing for I'm from Philadelphia, so the same thing is true for kind of that central Pennsylvania area. A lot of those steel mills, places like that. And so if you're in, say, a biotech hub, if you're in a Silicon Valley hub, if you're in a financial hub, those markets have done pretty well from this, say, $50 petrodollar system. Whereas the hubs that are built around making physical things, they're the areas that have mostly suffered.
Do you see that changing anytime soon?
We're starting to see early signs of change. So obviously we're starting with Trump, right? So obviously he popularized the idea of trying to shrink the trade deficit. right? I mean, that his approach didn't work, but he drew more attention to it. And then we're also seeing the whole the idea of reshoring things or trying to do, Biden talking about bringing semiconductor manufacturing back to the U.S. So it's kind of become this issue that's on both sides of the aisle about recognizing how much we've outsourced and then trying to get some of it back. But then, of course, you have all these corporate pressures that kind of like the status quo. They don't necessarily want to change it. And so I don't think that the boat has fully turned, but I think that there are more and more people trying to turn that boat and try to reverse some of those trends. Another thing that we're seeing on the other side is, so that's partially within the United States control, but we're also seeing that the deal of having all the global oil price in dollars is starting to change. And so there have been some countries in the past that did that, and it didn't work out for them. They got invaded and things like that. But Russia, for example, Russia's a nuclear power. They're one of the strongest militaries, and they said, we're going to start selling oil in euros. And so there's not going to be a lot happening militarily around there. And so they've been, if you look at, say, trade between Russia and China, so one of the world's biggest oil importers and exporters, that used to be almost entirely dollarized. But starting in around 2018, you've seen that's increasingly become euro, right? So even though the euro is not of their currencies, they're using the euro to settle a lot of that. They're also actually using some of their local currencies more so. And so, Russia's been kind of aggressively de-dollarizing, and you've kind of seen that spread a little bit throughout Europe, even between, say, Russia and Europe. And so Europe's obviously our ally, but you see that long-term trend is towards more of that trade happening in euros rather than dollars. And so we're starting to see kind of two ends. The United States is starting to become less thrilled with this situation is on our end, right? So we're tired of the trade deficits, especially certain regions that are being hit by it. But then we're also seeing globally countries saying, we can't just keep relying on the dollar to buy all of our commodities. And so a couple major currencies like the euro or the yuan are starting to say, we're going to go ahead and use some of our currencies to buy oil as well, so that you have kind of this, instead of like one currency to rule them all, you have a little bit more decentralized or diversified basket of a handful of regional reserve currencies. And so that's generally the direction we're seeing it head in.
So if I saw a similar statistic that the world reserve currencies, I think there's different definitions of how that's achieved, but if it's generally the currency that most people choose to do their trade and debts in is considered the world reserve currency. And I saw that statistic that China, Russia, and Europe in 2020, 51% of all trade became denominated in euros in the year 2020. And that trend seems to be firmly established. Is there some point, I don't know, I guess there's no arbiter or judge who actually declares the dollar is no longer the world reserve currency. I mean, how do you sort of figure out that out? Is it just something that the trade balances sort of decide that sort of thing, or is it people no longer accept the U.S. dollar denominating its own debt in dollars? They start insisting that the U.S. borrow in another currency. I mean, what is sort of the tipping point where we're no longer the world reserve currency?
Well, I think your first half listed the variables well. So you have, for example, you can measure it in terms of the percentage of trade happening in any given currency. Then you can also look at it in terms of what are reserves made of. That's kind of the most formal definition, right? Because you talk about reserve currency, it's what are different countries' foreign exchange reserves consisting of, and so those are kind of the main variables. And so we're starting to see, ever since 2000, right, about, over 20 years ago, since the formation of the euro, you've generally seen dollars, the percentage of global reserves consisting of dollar-based assets has been on the gradual decline, and a little bit more towards euros and other currencies. That hasn't really, that's kind of been this gradual fall. So that's kind of by many measures, that might have been the peak dollarization is around the year 2000, and you've already kind of come down from there. Now, in terms of your trade, we're starting to see, especially in Eurasia, we're starting to see more de-dollarization there, both in terms of reserves and in terms of trading volume. The third major leg to watch out for is, as you pointed out, debt. So the United States, the dollar is still far larger than the euro in terms of if you do a big cross section of emerging markets that have debt denominated in foreign currencies, the dollar still significantly outweighs the euro. And debt all represents demand for the dollar, right? Because all those entities that have dollar-based debts, they need dollars to service those debts. And so that's still kind of the big linchpin holding up the dollar compared to some of those other currencies. And so, if you start to see that shift more towards the yuan or the euro, that'd be kind of the last leg to shift, and that's been the slowest to change. Now, for the second part of the question, you don't have to be the reserve currency to issue bonds in your own currency. And so, for example, Canada is not the reserve currency, but there's still most debt in Canada is denominated in Canadian dollars. Same thing for Europe and euro. Same thing for Britain and the pound. So that's really more of a developed versus emerging market question. Most developed countries are able to have most of their debt or all of their debt denominated in their local currency. Same for Japan. And so that's more of an emerging versus developed market question rather than a reserve currency question.
Do you think we're at risk of losing it in the near future, this world reserve currency status? And number two, how does that affect the everyday person in terms of standard of living? If you know where I'm going with that.
Yeah. So for the first part of the question, I would say, a lot of times in the media is portrayed as an on-off switch, like you either have the reserve currency, you don't. Whereas I'm monitoring more of this as a spectrum, right? And so that basically we're slowly seeing that, the dollar might have been 80% of the market and it's drifting towards 70, 60, 50. And you could even get down to a situation where it's like 40, but it still could be the largest individual one. Like you could have 40% dollars, 30% euros, 30% yuan, for example. And it's so, yeah, I think over time the U.S. is going to remain one of the largest currencies, obviously, but that its overall dominance is going to decline over time. And you'll see, especially in Eurasia, more and more trade happen in the euro and maybe the yuan. And so that's kind of that long-term trend to watch out for. Now, as in terms of who benefits from it, one thing I mentioned before was, ironically, the median American has a lower net worth than many of our European peers and our Japanese peers, our South Korean peers. And so who benefits or is harmed by the system is really nuanced, right? So obviously, if you were to have a sharp dollar devaluation, that'd be kind of this painful period for the U.S. Whereas, in the longer run, that could actually make our exports and our manufacturing base more viable again, right? So someone working in those more physical types of fields could actually get a benefit from the global system becoming more neutral and diversified rather than so dollar focused. On the other hand, I think the biggest losers from that situation would be U.S. capital markets, right? So the U.S. is so financialized. You even have, for example, Switzerland. They print money and then they go and buy like Apple stock, right? And so that props up that's why part of why the S&P 500 is so kind of expensive compared to other markets. And so I think that, that whole kind of Wall Street industry, that'd be more harmed by the dollar losing its reserve status and piling into all these kind of U.S. large cap stocks. I think that inflow would turn into an outflow. And so one thing I'd point out is that I mentioned before, for example, the U.S. runs these trade deficits with everyone else. They collect all the dollars and used to buy our treasuries. Well, another thing they do is they collect all these dollars and they buy American assets. So they go and buy American real estate. They go and buy American S&P 500 companies, and so they actually own a large and larger chunk of our corporations and of our real estate. And so that props up the valuations. But it also kind of, detracts from American ownership of real estate, American corporations, because large and larger percentage of that is owned by the foreign sector. And so if that reverses, that could cool off American kind of asset valuations by quite a bit, especially in equities. That's where I think you'd see that show up the most. So it really depends on what industry you work in.
Lee, any other questions? You want to wrap it up?
We covered so much.
We did. This is great. We've got 40 minutes of great content. I'll edit out this little conversation, and just wrap up. But Lyn, we really want to thank you for giving us your time, and especially on a day like this with the market way down, and just sort of put it all in perspective. We really appreciate you coming on to Wall Street Silver and sharing your expertise. And thank you very much.
Thank you.
Happy to. And thanks for having me.
Appreciate the time.